Hello, my name is Katie, and here's why I believe Taiwan Semiconductor Manufacturing Company, or TSMC for short, is currently undervalued by the market. TSMC engages in the design, manufacture, and sale of semiconductors. It currently holds 54% market share in the total foundry segment, manufacturing on behalf of other companies. It is number 3 in the overall semiconductor market, behind Intel and Samsung. The majority of its revenues come from the North American market and the communications segment. Near the end of the 20th century, TSMC felt increasing pressure as more companies entered the total foundry segment. Through investment in assets while CFROI was above the company's discount rate, TSMC's management was successful in increasing shareholder wealth from 2004 onwards. Due to TSMC's high CFROI level relative to the mean, as well as asset growth fade, the company has a high speed of mean reversion. However, TSMC has shown itself to be capable of using R&D efficiently to maintain its first mover advantage, so it should be able to restructure and innovate to start the life cycle anew. Now let's take a look at the 3 key drivers of CFROI: sales margins and asset turns. Holt's valuation shows that the market is currently valuing TSMC based on the idea that its sales growth will decline to 3% by 2019. Stronger sales growth should be able to materialize due to the demand for smartphones from emerging countries, increasing adoption of the Internet of Things devices such as smartwatches, and as more companies choose to go fabless and outsource fabrication of semiconductors. TSMC has increased its whole operating margin from 34% in 1994 to 72% in 2014 and has the highest operating margin among its peers. As R&D costs become increasingly high in the semiconductor industry, rising roughly 40% per generation in the last decade, only companies like TSMC who sell in adequate volume can afford to invest in leading-edge technology and benefit from high margins. As for IDMs like Intel and Samsung, due to the inherent conflict of interest between them and many fabless companies, they are unlikely to gain as much volume or benefit as TSMC from these trends. In terms of asset turns, TSMC has been on a slow downward trend since 2004. In recent years, management has exited unprofitable subsidiaries such as solid-state lighting and solar, which will improve this metric slightly. Additionally, the company's low PE ratio relative to its peers despite its profitability as well as low Halt leverage ratio leads me to believe that the market is significantly undervaluing the stock. Some risks that TSMC shareholders will have to look out for include declining PC sales, high fixed costs, the cyclical nature of the industry, and high sales concentration. In conclusion, I believe that both TSMC's sales growth and operating margin have been underassessed by the market. In light of TSMC's competitive advantages of economies of scale and constant innovation, industry trends, and its undervaluation relative to its peers despite a healthy balance sheet, I can confidently recommend a buy for this innovative company.